This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Global oil and gas demand could grow until 2050, the International Energy Agency said on Wednesday, departing from its previous expectations of a speedy transition to cleaner fuels and predicting that the world will likely fail to achieve climate goals. The IEA, the West's energy security watchdog, has been under pressure from the U.S. for a shift in recent years toward a focus on clean energy policies as President Donald Trump called on American companies to further expand oil and gas production. Under the Joe Biden administration, the IEA predicted that global oil demand would peak this decade and said no more investment in oil and gas was needed if the world wanted to achieve its climate target.
Oil prices fell 1% on Wednesday, weighed down by oversupply in the market despite expectations that an end to the longest-ever U.S. government shutdown could boost oil demand. Brent crude futures slipped 66 cents, or 1%, to $64.50 a barrel by 12:32 GMT after gaining 1.7% on Tuesday. U.S. West Texas Intermediate crude was down 65 cents, or around 1.1%, at $60.39 a barrel, after climbing 1.5% in the previous session. Overall, both WTI and Brent remain well and truly stuck, with short-term speculative trading providing most of the activity, said Ole Hansen, head of commodity strategy at Saxo Bank.
Moving on to the top news in the energy sector.
World oil supply is expected to match demand next year in a reflection of the wider OPEC Plus group's production increases, an OPEC report showed on Wednesday, marking a further shift from its earlier projections of a supply deficit in 2026. OPEC Plus has raised its output targets by around 2.9 million barrels per day, or around 2.7% of global supply, since April. It plans to pause production hikes in the first quarter of 2026 amid widespread predictions of an oversupply. In a monthly report on Wednesday, OPEC said the world economy's growth trend remained firm.
U.S. crude oil stockpiles were expected to have risen last week, while gasoline and distillate inventories likely fell, a preliminary Reuters poll showed on Tuesday. 5 analysts polled by Reuters ahead of weekly inventory data estimated on average that crude inventories rose by about 1.2 million barrels in the week to November 7. An extended poll that surveys more analysts will be published on Wednesday. The poll was conducted ahead of weekly reports from the American Petroleum Institute at 4:30 p.m. Eastern Daylight Saving Time, 2130 GMT, on Wednesday, and the Energy Information Administration, the statistical arm of the U.S. Department of Energy, at 12 p.m. Eastern Daylight Saving Time on Thursday. Both reports are delayed by a day due to the Veterans Day holiday on Tuesday. Next, we have the top news in metal markets. Iron ore futures gained on Wednesday, as hopes of fresh stimulus from top consumer China outweighed concerns over a gloomy outlook stemming from growing supply and diminishing demand. The most traded January iron ore contract on China's Dalian Commodity Exchange closed daytime trade 1.38% higher at 774 yuan, $108.66, a metric ton, its highest since November 7. The benchmark December iron ore on the Singapore Exchange rose 1.31% to $102.85 a ton as of 0738 GMT, also the highest since November 7.
Gold prices were steady on Wednesday as investors awaited a U.S. House of Representatives vote on a deal to reopen the federal government, which could pave the way for clarity on economic data and the potential path for Federal Reserve rate cuts. Spot gold was steady at $4,125.22 per ounce, as of 11:58 GMT. U.S. gold futures for December delivery rose 0.4% to $4,130.90 per ounce. Everyone is awaiting more clarity on the government shutdown and when the data is coming out of the U.S. again, said UBS analyst Giovanni Stornovo.
We will now look at the top news in the agricultural sector.
Mexico on Tuesday implemented a new tariff for sugar imports due to falling international prices and the risk of oversupply in the domestic market, according to the country's official gazette. The new tariff of 156% per kilogram applies to all types of sugar, including beet sugar and syrups. Refined liquid sugar will be subject to a 210.44% tariff, according to a decree signed by President Claudia Sheinbaum and published in the official gazette on Monday night. Mexico is typically not a sugar importer, although in the last 3 sugar production cycles, foreign sugar purchases have risen significantly due to bad weather conditions that caused a drop in local production, along with lower exports to the United States.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.